Good afternoon, everyone. We hope you are all safe and sound. Thank you for attending our webinar today. And all of us here at Apriem Advisors welcome you to the third of our four-part series titled Apriem Portfolio Construction. I'm Rhonda Ducote, President and Senior Wealth Manager, and I, along with Josh Garland, one of our financial advisors, will be your host today. Today we will cover part 3 of the series, Growing Our Wealth. In parts 1 and 2, we discussed asset allocation and the fixed income markets. Today we'll be discussing a little bit more of an exciting topic, equities. When it comes to long-term growth, equities have proven time and again to be the asset of choice for investors. However, there are several things to consider when investing in equities, and one size definitely does not fit all. In this segment, we will discuss Apriem's approach to investing in equities and why it is important to invest with a systematic, rules-based process. I'm going to turn it back over to Josh now, and he's going to be introducing our speakers today from our investment team.
Starting with Benjamin Lau, who is the Chief Investment Officer here at Apriem Advisors. He's a graduate of UC San Diego in 1998. Where he graduated with a BA in economics and later went on to become a chartered financial analyst. He has over 2 decades of experience, starting at Fidelity back in 1998 and joining Apriem in 2002. Most recently, Ben was interviewed by the Wall Street Journal, giving his insights on the recent stock market meltdown amid the COVID-19 fears, as well as discussing U.S. stock optimism and valuation on trade. Ahmatovic is our second panelist. He is a financial analyst here at Apriem Advisors as well and works directly with Ben. Alan is a graduate of CSU Fullerton in 2015, where he earned his BS in Business Administration with a concentration in finance. He is also a chartered financial analyst. Alan got his start as an intern at Waddell & Reed in 2014 and joined the Apriem team in 2017. He was most recently interviewed by Investor Business Daily on exploring investment opportunities amid the COVID-19 pandemic.
Thanks, Josh. That was a great introduction. I appreciate that. Before we get on to talking about equities, I really want to do a quick recap of the last 2 webinars that we did. The first one was asset allocation, right? We talked about diversification and the real need to split your egg and not put all your eggs in one basket, right? And protecting your portfolio. The second webinar, we talked about fixed income and how we at Apriem really use fixed income and bonds for income and safety. Obviously, that income part is a little low right now with where yields are, but safety is still a big part of why we use bonds, and it's still a really important thing. The reason why we cover those 2 topics first is because those 2 topics are really the foundation for any good portfolio, right? We want to make sure that we know our goals, we know how we're going to invest the money, we make sure that we have the safety of the income set aside in case anything goes wrong, like you lose your job or anything. But now, let's talk about the exciting part, the growth part, right? That's the stock part, what we're really here for. And there's a couple important things about equities or stocks. And I think this is a great quote from Peter Lynch here, the famed money manager from Fidelity, where many of us got our career started. A big reason why I'm doing what I'm doing today. And it is important to remember that investing in stocks is not just a lottery ticket, right? There's a process to it. So that's what we want to share with you today. We want to go over what are equities. Why we do them? What are the different types of equities out there? How does Apriem invest in these equities? There's many types of ways to invest in equities, but how does Apriem do it? And then most importantly, why? Why do we do it that way?
Great, Ben. Thank you so much. But I think we should have a little bit of fun now. So that's going to take us to our very first trivia question. What percentage of the S&P 500 do the FANG stocks represent? And for those of you who don't know what the FANG stocks are, it's Facebook, Apple, Amazon, Netflix, and Google. So is it A, 25.5%, B, 16.5%, C, 12.25%, or D, 20.75%?
The answer is B, 16.5%. These technology companies really have become a huge part of our lives, right? They've really grown to just a little under a fifth of the S&P 500 when weighted by market cap. It's also a timely one because it's a big week for a lot of these technology companies. As we speak right now, 4 out of the 5 FANG stocks, the CEOs are speaking in front of Congress right now. Facebook, Apple, Amazon, and Google CEOs are now speaking in front of Congress right now. And to top off a busy week, most of them report earnings tomorrow too. So we're going to get a nice insight. The PR teams are really busy right now.
I think this is a good time to kind of ask a key question here, because it took me a while to understand the significance of what we're talking about here with these FANG stocks, right? So we have these 5 stocks. We say they represent 16.5% of the S&P 500. I mean, what exactly does that mean? What does it mean to be market cap weighted?
That's a great point, Josh. Thanks for bringing it up. As you can note from the S&P 500, there's 500 companies in this index, right, that we talk about, that we represent a lot about American companies. In the 500 companies, and they're all broken down by what we call the market. How big are they? And so that's really a function of how many shares they have outstanding times the current share price. And these companies have grown so large, they become such a big dominant force of the market. And so out of 500 companies, 5 companies represent almost a fifth of it.
What are equities?
Great, yeah. So from the most fundamental level, equities, or aka stocks, are essentially ownership of an operating business. So when you think about a business, it's essentially a collection of assets that are funded by a mix of debt and equity. And so you can think of a home as a perfect analogy to this. A typical homeowner has a house that carries a current market value and a mortgage, which is a form of debt. And any residual value of the house, after you subtract out the mortgage, is the equity of the house. So a business works the same way. So this triangle here represents the capital structure of a typical business, which refers to the different forms of capital that are used to fund a business and the priority of each form when it comes to getting paid. So from a high level, these are broken down into debt and equity. And so like we mentioned a few weeks back, a company's debt holders have the highest priority in getting paid and have the first claim on a company's assets in bankruptcy. So therefore, debt is the lowest risk, lowest return form of capital. But then we have equity, which is broken down into preferred equity and common equity. And these often get used interchangeably, but they're actually entirely different.
Alan, if I could stop you right there for a second. I get this question a lot from clients and, during portfolio reviews and such. So can you really kind of dig into the difference between preferred stocks and common stocks for us?
Yeah, so this graphic here does a good job depicting that. So the typical preferred equity actually has characteristics that most closely resemble a bond. So they're lower risk, lower return relative to common equity because they're higher up on that capital structure. They do not participate in the growth of the business, but they come with a fixed dividend. And lastly, they don't offer any voting rights to vote on matters of the business. However, they can act as sort of a hybrid between the two. So preferreds can range from having a set maturity like a bond to being perpetual, so they have no maturity and are basically there forever. They can also include conversion features that allow investors to convert the preferred equity shares into common equity shares. And so now to dig into common equity. So common equity refers to how we traditionally think about stocks. So when we mention that we're buying stock in Lowe's or Facebook, we're usually talking about the common equity. So these are higher risk, higher return, again, because they're the lowest on the capital structure. They do allow you to participate in the growth of the business, but they come with a variable dividend, which is determined by the company's management. And lastly, they do allow you to vote on matters of the business. And so this is what we really focus on here at Apriem. We're primarily investors in the common equity of corporations. And so when it comes to investing in common equity, you can really focus on 2 different types. These are the common equity of publicly traded corporations, which is referred to as public equity. And then there's the common equity of privately held corporations, which is referred to as private equity. And so from a fundamental standpoint, they're basically the same thing. They're ownership in an underlying business.
So, I mean, between the two, though, what are kind of the key differences between public equity and private equity?
Yeah, so there's really 3 key differences that are important for investors to know. And the first has to do with access. So public equities can be bought and sold by anyone through a stock exchange. So that a few examples here in the US would be the New York Stock Exchange and the NASDAQ. And for the most part, public equities are highly liquid, which means they can be traded at any time and at a low cost. And in addition, they're much more transparent, as all financial information of publicly traded companies is required to be made public by the SEC. And so when it comes to private equities, these are a little different here. These are only available to institutions and accredited investors, and you must become a limited partner in a private equity fund, which are typically ran by large private equity companies. And so we listed a few here. One is Blackstone and the second is Apollo. So these are two of the largest private equity companies in the world. And so when it comes to private equity investments, they're highly illiquid. So it means that it takes a lot of time and costs a lot of money to buy or sell shares in the private market. And these investments are a lot more opaque. Privately held companies are not required to disclose their information to the public. So it really kind of leaves that whole market a little bit more mysterious.
So there's a lot of hype that circulates around both public equity and private equity. Does Apriem, do you guys focus on both segments?
So here at Apriem, we really focus mainly on publicly traded common stocks, and you can really break these out into and think about them in two separate categories. So the first is size, which refers to the market capitalization of a company. So this is basically the number of shares outstanding times the current share price of the stock. And there's really three categories when it comes to size. The first is small cap stocks. So these are stocks that range from about 50 million in market cap to 2 billion. The second is mid cap stocks. So these are stocks that range from 2 billion to 25 billion in market cap. And then the third is large cap stocks, which range from about 25 billion in market cap and above. And then the second kind of high level category that you can use when you're thinking about publicly traded common stocks is geography. So this is broken down again into three separate categories. So the first is domestic equities. So these are stocks that are based here in the United States. The second is developed international equities. So these are stocks that are based and traded in developed international markets like Europe, Japan, and Australia. And then the third is emerging market stocks. And so these are stocks that are based and traded in emerging kind of more growing economies. And a few examples there would be China, India, and Brazil. And when it comes to investment options, you can really mix and match your exposures. For instance, you could invest in small cap emerging market stocks. You could invest in mid cap international stocks. But here at Apriem, we mainly focus on domestic large cap stocks.
Why? Why are we taking on this extra risk and investing in equities, right? Because they are a little bit riskier than other asset classes, and clearly it's for growth, right? I mean, that's what most people invest in equities for, really, as the growth area of the portfolio. That's what keeps their head above water, above inflation. That's what funds their retirement. So here what we did is we broke down a chart here of how different asset classes, stocks in green, bonds in blue, and cash in yellow, how they do during different inflationary periods, right? And that's a real big concern, especially now with what's happening with COVID and all the printing of the money by the Fed and other central bankers across the world. And so, it shows that when inflation is low, call it under 4%, under 2%, almost everything does well on an inflation-adjusted basis, or on what we call a real inflation-adjusted basis. Stocks do really good at the time, but bonds and cash do okay too, especially when inflation is negative. But what happens when inflation starts coming back, and anything over 4%, right? And definitely anything over 6%. Even on an inflation-adjusted basis, stocks still do okay, right? And when inflation is over 6%, equities still do okay. And here in this chart on the far right, you see the equities do about a negative 2% after inflation. Okay? That still hurts, but it's still much, much better than returns on bonds and cash, And that's really the concern, right? As we build portfolios, not for 1 or 2 years out, when we build portfolios for 10 or 20, or in many cases 30 years out, inflation is a big concern. It hasn't shown itself recently, but it is something that we always worry about when we look back to the 80s, and making sure that we have enough hedges against that is really important. And so what we do is when we talk about equities and inflation, we talk about, well, how do we get those returns, right? How do we actually mathematically build up to what our models, right? And so really what we did is we've broken down returns into 3 real big sources. Before I go to that, I want to talk about the total return you see on the right side here. So how we measure performance is 2 components. How much did the actual asset grow in value? You bought something at $100, now it's at $125. You had a $25 gain, right? That's a capital appreciation. And if that dividend, if that investment or whatever paid you another $5 in dividends, that adds to the total return. So you had a return of 25 plus the 5, you made a total of $30 on that investment. That's what total return is. And so total return is a combination of the dividends, how much the company is growing, and then the multiple expansion. So the dividends is this current income, right? That's what you get. That's what you get a few times a year, and that's what you can bank on and live on. And right now, the market is yielding about 2%. That's been pretty consistent over the course of history. The second one is multiple expansion. That's a tough one. That's investor sentiment. How do we feel in valuations, right? When we talk about PEs and stuff like that, those can vary wildly across time. And then the last one is earnings growth. How is that underlying business growing, if at all, right? Are they appreciating? Are they doing constructive things with their capital? Are they being good stewards of capital? And how is that business going? And that usually also goes up in value, usually anywhere from about 2 to 9% a year. So that's relatively consistent too over the last few decades. But clearly, the biggest issue here is the investor sentiment. That's the hardest thing that we have to gauge, right? Because valuations can change so rapidly, even though an underlying business can change so rapidly. And I don't need to tell the people in the room here this, but we saw in the first 6 months of this year, we've had a huge change in investor sentiment in just a few months. And so that's been a big change, and that creates most of the risk. And that's what most of our process revolves around, is trying to minimize the investor sentiment and try and take a more data, process-oriented approach to our investments. But that risk is still a big one out there. And so the investor sentiment does pose a lot of risk to investing in stocks. So how do we think about risk for you, for your portfolio, for the assets that we have? And we really define risk in 2 different ways. Number one is volatility, right? How much is that asset class moving? Don't need to mention again this year. There's been a lot of volatility in the first 6 months of this year. But the second way we think about risk is that permanent loss of capital, right? And again, you see that too if you invest in some of these retailing companies, right? Some of these companies have Brooks Brothers, or some of these energy companies have gone out of business. That's a permanent loss of capital. And so how we review risk, we really try to minimize one. The stock A is the volatile stock, right? That goes up and down, but it generally goes up over time, right? It has these big moves up and big moves down, but generally it's a great company, and stock A is something that you want to own. You just have to minimize it when it goes down and not really worry about the volatility of that in the short term, because that's just short term. The real big risk that we focus on here at Apriem is that permanent loss of capital, stock B, right? If you invested in Brooks Brothers or some of these other energy companies like Chesapeake recently, that's a permanent loss of capital, right? That went to zero, you're not getting your money back. Get in line in court. Right? And so that's the biggest risk that we worry about, and that's the things that we try to avoid when we look for investments.
Well, thank you, Ben. Now that we've talked about permanent loss of capital, something not fun, let's talk about something a little bit more fun and jump into another trivia question for everyone. What company is not listed in the S&P 500? Is it A, Lululemon, B, The Gap, C, Tiffany & Co., or D, Dollar General?
Lululemon. Hey. The reason why Lululemon is not in the S&P 500, it's actually, first of all, Lululemon is a really large company, right? It's about 10 times larger than The Gap and about 3 times larger than Tiffany, right? Big, the blue box Tiffany. I can't believe it's bigger than that. And so yoga pants are really popular, I guess. Biggest reason, there's a few criteria to be listed in the S&P 500. Rhonda mentioned it a couple weeks ago in our letter to clients. When we're talking about Tesla, right? And the big issue for a lot of companies is profitability, having at least 4 quarters of profitability. That's one of the criteria. Lulu and all these 4 companies really meet that criteria, so that's not an issue. The other criteria is that the company needs to be headquartered in America, and Lululemon is based in British Columbia, Vancouver, British Columbia.
Well, I know I've done my part to keep Lululemon in business. They are my favorite yoga pants. So thank you for that, Ben. That was fun. So now that we have a good understanding of what equities or stocks are, I'm going to kind of put it back to you, Ben. And can you tell us, how does Apriem invest in equities or stocks?
Great. And so this is really the meat of it, right? So before we do that, let's back up a little bit and talk about our various investment strategies here at Apriem, and then we'll expand upon that. So I want to cover a couple of ones on the right, starting from right to left, and some of the easier ones. On the passive manager side, I think you'll recognize this chart from the asset allocation presentation we did a few weeks ago. On the right-hand side is the passively managed or passive index strategies that we have. pretty much we said all passive, right? We use a little bit of active strategies in here, but a lot of ETFs, a lot of mutual funds in here just to get exposure, and it really stays to that allocation of either 100% stocks or 75% in stocks and 25% in bonds. But really using ETFs on the equity side, that's pretty simple and pretty simple. On the tactical side, we use similar strategy using all ETFs, but we trade them on a tactical basis, right? We trade them on moving averages and technical indicators, looking at chart patterns to really prevent downside and protect portfolios. But by far, our largest strategy, our oldest strategy is this global allocation strategy on the left side. Yes, we have different asset allocation versions of that, but that's our biggest strategy, and that's what we want to focus on today. And so how we manage global allocation is really using the same strategy that we talked about with fixed income, right? Using a core and a satellite approach, making sure that the core of the portfolio is really solid, well run, usually passively managed index, and make sure that exposure is really cheap and low cost and tax efficient. And for us, we use a few funds from the Charles Schwab Investment Management ETFs for that, and that gives us exposure. And we like it because it allows us to be more targeted with the opportunities or the satellite areas in those individual stocks you see orbiting the core, right? And different times can mean that there's different opportunities, and so we try to look for those opportunities when they present themselves. But we have a big core in the middle that allows us to be opportunistic when we need to be, and less opportunistic when we don't want to be. I also want to point out in that satellite that the individual stocks, and they could differ from client to client because they're based on the opportunities that we see today when we're deploying cash. And so a client that's been with us for 15 years might have different stocks than a client that's been with us for 15 months, right? There was different opportunities 15 years ago than there was last year. And so we try to manage that. We try to buy stocks just when we think there's a current opportunity, not just because it's for everyone to have it. Let's focus a little bit on the beta first, though. I think that's the more important thing. That's the way we anchor the portfolio. The beta, what we consider the beta, the core of the portfolio, is really broken up into two areas: the United States and outside of the United States. And currently, the biggest index we use for the U.S. is what everyone should know, right? The S&P 500, the big blue chip companies in America. 500 companies that are dominated here in America. Outside the United States, we have a mixture of developed market ETFs and emerging market ETFs. Developed markets, you think of really bigger, older economies, Europe, Japan, to a certain extent, a little bit in Australia. And the emerging market countries are the younger companies, the growing companies. And I would really think of China and Asia Pac as those emerging market companies. We broke it down for us. It's about 75% in the U.S. and about 25% overseas. The current investments we're using for the U.S. domestic markets, the S&P 500 index, is as simple as SCHX as in Xerox. And for outside the United States, the developed markets, we're using a Schwab ETF called the SCHF as in Frank, and emerging markets is SCHE as in emerging.
So, Ben, I think it's a good time to jump in here really quick, just because I've gotten this question before when I've met with people. And so as we think about this core beta piece of the portfolio, and we're using these Schwab ETFs. Now, there's all kinds of different places we can get exposure to the S&P 500 index, right, or developing markets, emerging markets. You think of names like iShares or Spider, right, and there's these different ETFs that are out there. Why have you chosen to use Charles Schwab's ETFs?
Well, that's a great question, and we've been using ETFs for quite a long time. So our policy, our thoughts on this have evolved. And primarily because it's been a huge price war for the ETF. It's been a really crazy 10 or 15 years in the ETF business, and a lot's happened. A lot of evolution has happened since then. And so when we do a due diligence search on an investment we like to use, especially on the ETFs, there's two main criteria we look for when we look at these beta ETFs. Number one, is it doing a good job, right? Is it tracking that index or at the S&P 500 in this case well, right? Is it mirroring the returns? Most of the big ones, the ones from Vanguard, the ones from iShares, the ones from Schwab, do a good job doing that. There's some smaller ones out there that don't do a good job, but we make sure that we follow a good ones there. The second one, and arguably the most important, is cost, right? And there's two costs that we worry about: the underlying expense ratio or the operating expense ratio of the fund, a fee that you never see that's just embedded in the fund, and then the other cost is the commission. How much does it cost to buy and sell it, right? And so the good thing is that in the past 10 years, there's been a huge price war on that operating expense ratio issue that I had. Vanguard used to be the big pioneer in the space. They used to dominate it in terms of low-cost products. But 10 years ago, other firms stepped up and said, we could do this too for cheaper. And so a price war erupted between iShares and Vanguard and Schwab. And at the time when Schwab launched these ETFs, we were one of the first users of it. Schwab undercut everyone. They said, hey, we're going to make this cheaper than all those other competitors. And so they undercut them. And on top of that, what Schwab also did is they made trading Schwab ETFs free. And so at the time, we had to pay $4.95 or to buy and sell a Vanguard ETF or iShares ETF, but the Schwab one was free. And so we made a determination that all in all, the Schwab ETFs were doing a great job at mirroring the index. And number two, they were cheap from an operating expense ratio and then from a commission basis. So that's why we used those Schwab ETFs at the time. A lot has changed, right? Fast forward now to 2019, last year, when Schwab cut commissions to zero. And so now that's been a huge boom for us. We're super excited about that. Now what we can do is we can look at levels of playing field for all these ETFs. We can go anywhere to look for the best ETFs out there for our clients. Luckily, we still do this research, and the Schwab ones are still really, really good, especially relative to Vanguard and iShares. And it's still phenomenal how competitive Schwab is with this. But we're not beholden to Schwab. We can always change it around.
Alan, could you help us understand how we find alpha in our portfolios?
Yeah, so that's what really the satellite positions come in. So the satellite part of our portfolio is really about picking stocks that are going to outperform the benchmark over the long term. And so we really approach this by viewing ourselves as investors and not traders. And so this means we buy stocks from a business owner perspective, and we really conduct our analysis on the underlying business, not just recent moves in the stock price. And so we look for businesses that we feel confident and comfortable buying and holding for the long term. And so these businesses have two primary characteristics that we look for. One is the business must have an economic moat, and the second is we must be able to buy the business with a margin of safety. And an economic moat is a source of a sustainable competitive advantage that helps a business outperform its competition over the long term. And a margin of safety is simply buying a stock at a significant discount to what it's worth. And so this does really two things for us. It helps protect our downside if the business deteriorates or if the market falls for an extended period of time. And it really just simply puts the odds in our favor to outpace the S&P over the long term. And so now we're going to dig into what economic moats, what they are, and the different sources. So like I mentioned earlier, an economic moat is a source of a sustainable competitive advantage that helps a business outperform its competition over the long term. And the term was actually coined by Warren Buffett, and it refers to how in the medieval days, the castles would construct a body of water or a moat around the castle to keep invaders out. And so with a business, an economic moat works in the same kind of way. It's a competitive advantage that helps a business fend off its competitors who want to come in and steal their profits. And so there are 5 primary sources of an economic moat. The first one is brand power. This one's pretty simple to understand. I think we can all agree that we would prefer an ice cold Coca-Cola over an RC Cola, even though they essentially taste the same. The second is intellectual property, and this refers to patents. And Johnson & Johnson is a great example here because they have a broad base of patents that really prevent competitors from copying their products. And the third is cost advantage, which basically means selling a product or a service at a lower cost than competitors. And Lowe's is a good example here because they're able to charge lower prices than small local hardware stores because they purchase their inventory in bulk and at a lower cost. The fourth is switching cost, and this comes from the high cost to switch to a competitor. So Stryker, the medical device company, is a great example here because a lot of their customers are hospitals and clinics, and it costs hospitals and clinics a lot of money to switch from one supplier of medical devices over to another. And the last is network effect, which refers to how a network becomes stronger the more people that use the network. So Facebook is a great example of this. The more users on Facebook means a greater audience for advertisers, which leads to higher ad revenue for Facebook, who then can invest back into the platform to make it better for users.
Well, I know that we all like talking about moats here, but they can be quite confusing. So, Alan, just because a company has a moat, does it make it a good investment?
Yeah, so that's a great question. So really for us, having an economic moat is really just the first step. And so what we do here at Apriem is we start by taking all companies that have an economic moat, and then we break them out into two separate sleeves. So the first is a revenue growth sleeve, and the second is a dividend growth sleeve. And so each sleeve consists of its own investment universe. The revenue growth universe consists of wide moat companies that have demonstrated a long track record of high quality revenue growth. And then on the flip side, the dividend growth universe consists of wide moat companies that have demonstrated a long track record of high quality dividend growth. And so from there, we consolidate each universe down to a watch list. And this is meant to focus on the companies that have grown their revenues or their dividends in the most efficient manner. And this watch list contains roughly 20 to 30 stocks, and we update it every 6 months. And from here, we monitor the watch list on a daily basis using our proprietary valuation model. And so we look to buy companies on the watch list when they fall to a 25% discount to our intrinsic value estimate. And so really our long-term goal is to own 5 companies from each sleeve, so 10 total. It doesn't always work out this way, but it's really what we're shooting for. And so just to kind of wrap everything back up, this 25% discount that I mentioned, this is the margin of safety that we're referring to. So to kind of conclude everything, you can see how we really implement our stock picking philosophy into a very consistent and rules-based process.
These are all individual companies that we have purchased using the process that Alan just walked us through. So we have Cintas, Stryker, Intel, T. Rowe Price, Facebook, ADP Biogen, and Medtronic. And we want to play a game. So what we're going to do is for this next poll, we want everyone to vote on which company you think has had the best performance since the time we have purchased them, all right, following this process. But I want everyone to have a fighting chance in case some of you have not been watching your portfolio every single day. And we're going to knock 3 of these right off the list right off the bat. So we're going to get rid of Stryker, Facebook, and ADP. And I'm going to go ahead and open the poll for you all right now to go ahead and submit who you think the best performer has been out of Cintas, T. Rowe Price, Biogen, Intel, and Medtronic. And really quick, I will share the results with everyone. So 33% of our respondents said Cintas, 13% said T. Rowe Price, 33% said Biogen, 20% said Intel, and 0% said Medtronic. Okay, so just to continue to have a little bit of fun here, we're going to go ahead and we're going to give everybody a fighting chance to resubmit their votes, but we are going to knock 3 more of these off the list. T. Rowe Price, Biogen, and Medtronic are all going to go away. And now you have a 50-50 shot between Cintas or Intel. I'm wondering how many people are going to change their answer. All right, we're launching. Go ahead, we'll give you 1 more minute. Alan, would you like to share with us what the correct answer was?
Yeah, so the correct answer is indeed Cintas. And so, to give a quick background on Cintas, so they provide work uniforms and sanitation and safety services to businesses of all sizes. And they've actually been on our watch list for a while now, but we haven't been able to buy them at a significant discount. And that really changed when COVID hit. So as we all know, the S&P was down about 35% during the first wave in March. But Cintas actually got hit even worse than that. And the main reason for that is a lot of their customers are other businesses. So it created a great degree of uncertainty because a lot of their customers were being forced to close. And so this sent the shares from the low 300s to about the low 160s. And for us, this was really a great opportunity to buy a great business at a significant discount, since we don't see the COVID situation really impacting their underlying business over the long term. And so as you can see from the chart, that little red circle there on the bottom, that's where we bought into Cintas after it fell during that time period. And since we bought it, the stock's up about 84%, which makes it our best pick the year thus far. But we would be remiss without talking about a pick that hasn't done as well, and that's Intel. And so quick background on Intel, they manufacture and design semiconductors that go into that really power our computers and our data centers. And Intel was added to our watch list at the start of this year, and the company is currently in the process of transitioning its focus from making chips for CPUs or computers to making chips for data centers. And the data center business actually offers a much higher growth prospects for them, and we're confident that they're going to be able to successfully make this transition. However, it's really creating a great deal of uncertainty among investors, and that's really that's caused Intel to trade at a pretty steep discount to its peers, basically throughout this whole year. And so we started buying Intel here at the first red circle. It was right at the start of the year, and we added to it in March when COVID hit, and all stocks across the board were kind of down a bit. And since then, it began to trend higher, but it really got hit hard this past week when they reported earnings. It fell by about 15%, and that's the third circle there, the third red circle. And so just to touch on this, their numbers were actually quite good. They beat on both the top and bottom line, but they disappointed investors when they announced that they're going to delay the release of their new 7nm computer processor. And so this was pretty tough for Intel because it really could cause them to lose a lot of market share in this segment. But it doesn't impact the data center business, and that's really what we're focused on, and that's really what's going to drive their growth in the future. And so our plan with this is we're going to continue to hold it because we are confident in the underlying business despite this drop. And we're looking to add for clients who are underweight it, and we're also going to be aggressively purchasing for new clients as well.
Thanks, Alan. That was really interesting. I'm glad you were able to explain that for everyone. Ben, I'm going to turn it back to you for this last segment. So we now know the what and the how, but can you tell us why Apriem invests this way?
Yeah, that's really important, right? That's really the reason why we're here. The biggest thing is that we want obviously a process around our investment strategy, right? And that process needs to be around data. It cannot be based on emotions or political beliefs right now. Then that's why we use hard data, and because it's that investor sentiment issue that I was talking about earlier. It's talking about that changes so much, and if we can come up with a process that really tries to minimize investor sentiment, that's really our goal here to be aggressive when some of these stocks have opportunistic tendencies. And so having this process really allows us to be process driven around data. It also allows us to be opportunistic when there's opportunities, right? We can allow us to jump on them when we see something that's at a really attractive value or attractive deal here, and buying great franchises at great prices. So that's not always the case, right? This, with the market being near all-time highs now, there's less opportunities today than were maybe a few months ago, but the process really drives to uncover opportunities and when we see them. Of course, the real big reason, Rhonda, at the end of the day is returns, right? We're confident that we have this process in place that focuses on long-term, great companies for the long term. We're confident that's going to boost returns. We're confident investing in these companies do generate higher returns than just the index. And more importantly, from a risk management standpoint, it really allows us to know these companies, really get to know them, really dig deep into the situation, and make sure, from a risk management standpoint, we don't have that permanent loss of capital, right? We can't control volatility, but we can really control that permanent loss of capital, and that's really what we're trying to avoid for clients.
Well, great. Well, thank you for that as well. We're right at about 40 minutes right now, so why don't we stop there and open it up for some Q&A?
So we definitely had some questions that came in during the course of the presentation. Hello, everyone. But I want to actually start with a question that I received over the weekend. I actually got an email from somebody asking that we address this during the webinar today. So Ben, Alan, I'll let you guys kind of decide who wants to run with this first. But here's the question. It says, my friend's investment manager said that in the next 3 months, we are going to have a market drop. And she should move her 401k into a general stable income fund. Would you recommend that also? We have a 401k. Should we be doing that? It's worth about $1 million today.
What a great question to start this off, right? Because this is a really timely question. Looking at we're about midway through the year. We've got a COVID situation happening, and then obviously a presidential election coming up at the end of the year. First of all, Josh, let's start with the basics, right? Let's start off with we always like to start off with everything. the financial plan, right? We have to make sure that we know what the money, the goal for these monies are. Is it for retirement? Is it supposed to last, 1 year or 2 years? Is this money to buy a house in the next year? Right. So that's the biggest factor. What's the kind of time frame and the goals for this money? And as long as that's set up, let's assume that's set up. And so that you're not going to need this money for 10 or 20 years, and it's kind of for retirement. I would ask, what your allocation is, what kind of short-term cash you need, but say you don't need it. The real question is, should you go to cash for a proportion of your 401k because you're worried about the next 3 months? And it's so hard to tell, right? Look what happened just 3 months ago when in the middle of this COVID situation. Almost every Wall Street analyst, almost every talking head on Wall Street was so concerned about the economy and about the stock market in late March. And they were all right? There was a lot of problems going on, but look what the market did. The market has made one of the best runs in history. So predicting short-term moves in the market is super hard, no matter how educated you are, no matter how much based on data and the economy, because there's so many different dynamics to what moves the market. So investing over the short term is really tough. And the other issue I have also is that how do you get back in, right? So you did go to cash. What do you do next? What happens if you're wrong, and what happens if you're right? If you're right, the market does swoon. What's your process to get back in? If you're wrong and the market just continues to go higher like it did in the last 3 months, what's your process to get back in too? So going to cash promotes, it just carries a lot more questions and strategies.
I think that's great. Too, Ben, because I think it does. It goes back to first your financial plan, discussing it with your wealth manager, and then of course asset allocation. Going back to the very first. The first part of even our series is like, what allocation should you be in over the different stages of your life? When you're young, you should maybe have a higher allocation to equities, and as you build your wealth over the years, and as you get closer to retirement, you adjust that allocation and your risk tolerance. It's been kind of interesting even in this environment, Benjamin, because obviously with interest rates being so low and you going to cash, and you kind of mentioned it during the presentation, going to cash, interest rates being at zero, we know that that's not going to get clients or investors to their financial goals.
Yeah.
So great point. So I thought that was a great question to start things off.
Yeah. If I was on the other side, right, if I was one of the listeners, what I would want to know is, okay, let's say that a drop does come in the next 3 months, right? So that actually comes to fruition and it occurs, right? And we understand that, okay, it's hard to predict things, but what if that does happen? What does your team do in the face of something like that? What are you guys going to do if that occurs, right? Would it have been better for us to go to cash now and wait for an opportunity, or do we remain invested? How do you guys approach that kind of a situation, that kind of a thought?
So we kind of listed out the 3 different strategies we have here. So I would say the tactical strategy, the first example, that strategy is going to go to cash. If the market goes down a lot, the whole idea of it's to protect you on the downside. The passive strategy will kind of just it'll stay in the passive ETFs and kind of ride those ups and downs. But our core strategy, the global allocation, is going to use that drawdown to really take advantage of opportunities in the market. So like we walk through with our process, we have a watch list of companies that we're continuously watching. These are high quality businesses that we want to buy and hold for the long term. So when the market does dip, that presents us a great opportunity to go in and buy those businesses, at a margin of safety, at a discount. So we can give you a few examples of what we actually did earlier this year. So when the whole COVID thing started to happen, one of the companies that we had owned for a while, which was Clorox, had a large run up in price, and so it actually became overvalued based on our models. And that's largely due to a lot of people, going in spending on cleaning products and things like that, to really push the stock up to overvalued levels. And so what we did is we decided to sell at that overvalued point, and then go in and buy some new companies on our list that started to trade at a discount. 2 examples would be one, Cintas, which we already discussed, and then Stryker, the medical device company, is the other one. And that move, turned out pretty well. Clorox has trended higher a little bit since then, but Cintas and Stryker are up. Cintas is up 80%, Stryker's up in the roughly 30 to 40%. So.
I think it was Warren Buffett that said investing is simple but not easy.
Right.
And I think that highlights it perfectly because, everyone knows, oh yeah, you're supposed to buy low and sell high, and it sounds so incredibly simple, but it's not easy to do. In fact, Rhonda, how many phone calls did you get when we sold Clorox asking why are you selling Clorox right now? It's the only thing in the market that's going up.
Yeah.
Right? Because I got those calls. I mean, how many people did you talk to that were saying the same thing?
Yeah, several. I mean, it's hard to sell when things are up. I think one of the big questions we got, not just when we sold Clorox and we sold it for a really great profit, but, obviously, paying taxes is a consideration too, or capital gains, especially when it's in a non-retirement account. So got a lot of questions about that. I think that it goes to show why you need to know why we're investing the way that we are and what our model is and what our investment strategy is. And so, maybe Ben, you can talk a little bit about that, maybe take that example like Clorox and why we would sell with something that's so positive in the news and buy when something's so negative in the news.
Yeah, I mean, it's obviously tough, Rhonda, right? When we talk about all these concepts, it's not just teeter-totter. It's not like a binary outcome, right? There's many things that we're trying to balance. It's not like balancing a stick. It's more like balancing a plate, right, where there's multiple dimensions with to deal with. One of the biggest issues is what Alan already addressed. Is just what we think when a situation like COVID happens, and right now, quite frankly, too, where we see that there's something that we want to buy, we do the analysis of things that are really expensive, right? And that's what we talked about Clorox here. But behind that also, we talk about other stuff that's expensive too. Clorox wasn't the only name on the list. So we had that list, we also have to figure out not just what's the most expensive, but what's the most tax advantage thing to sell too. And so clearly, I mean, long-term gains are much more attractive than short-term gains, and that was taken into consideration too, as well as our equity weightings and different sector allocations that we have, and that's why we came to Clorox. The things to sell was a long-term gain. Again, Rhonda, we're having an issue right now because, not many names are on our watch list are that cheap right now, but we're prepared for if we do have a market soon. So what will we sell? And tax are a big consideration of that. And that's why we started to see some sales in many client portfolios of long-term gains.
Right. Awesome. Let's move on to another question. I think this is a great one because it's been in the news for a long time. Boeing. Okay. Boeing has had some troubles clearly this past year, with the MAX jetliner and it being grounded. So one of the questions is, how does a company like Boeing fit the alpha model?
Okay, that's great, right? And so let's walk through that three-step process that we have, okay? And the first one is easy, right? The most thing. I think, as many people know, Apriem is in the model for a new jet. And so there's only a couple of jets that we can look at, right? So we can look at an Airbus jet to fly us around the conferences, or a jet from Boeing to fly us around all these conferences. There's not many. You're not going to really go with a Bursar or Bombardier, right? You're going to go with a big one because we need a really big jet to fly our clients around. So Boeing has clearly the most.
Well, and they're probably the safest now, too.
Right, the safest.
Well, then the other thing to point out, there's really only two companies in the world that make these big jets and airliners. It's Boeing and Airbus.
It's a duopoly, right, between Boeing and Airbus. There's two, so they have a great moat. It's so expensive to start production on. It's so much capital intensive to start production on one of these airplanes. So Boeing has a great moat, just like Airbus. So that's the first step. They meet that, right? The second step really is, have they paid out a dividend, or have they consistently grown revenue? Are they consistently cash flow positive? And that clearly is not, right? They were up until recently with the whole MAX situation, so that's caused a huge decline in cash flow. That could continue for a while. The other issue is that Boeing does suffer, like many industrial companies, a really long business cycle where they spend a ton of cash and capital when they start production of a plane, only to recoup that over 20 or 30 years with service contracts, like they're doing with the current. I think Air Force One is being remodeled right now too, and so it's the same thing there too. So Boeing is a great moat, great company, but just not the kind of cash flow and business model that we like to invest in.
Yeah, and really to add to that, so like we kind of showed in that slide about our process. So yeah, the economic mode is the first step, but really the next step we're taking is we're looking for companies that have done a great job growing their dividend or growing their revenue. So that's really the second step in there. So we're being very targeted and specific when it comes to the companies that we're eyeing in on to add to our watch list. And so a company like Boeing, it does have a wide economic moat, and it's a great company, but it doesn't fall into one of those two specific buckets. And so it doesn't mean it's bad. It just means that it doesn't meet those key criteria that we're looking for, which are really important, because that's what essentially a business can really do two things. It's either reinvesting back in the business to grow the revenue, and it's a revenue growth business, or it's at that more mature stage where it's paying back profits back out to the shareholders and growing that, and it's in the dividend growth stage. So that's why we focus on those two things. Boeing it doesn't meet those filters right now.
Do I continue to hold Apple? Now that gets asked a lot.
Well, that's a great question. We're kind of will touch on this on the next webinar, right? Shameless plug for the next one. But it's not just about the company, right? It's about other things, about building a portfolio. And one of the things that many people forget when building a portfolio is something called position size. How big is it of your portfolio? Apple is currently about 5% of the index. So anything over 5% is pretty high, right? Now you have what you call a lot of single stock risk. So if your portfolio is 5, 10, 15, in some cases 90% of your portfolio, that proposes a lot of single stock risk. You probably made a lot of money this year, and you take some chips off the table, right? Kind of like it was with betting. If Apple is maybe 2 or 3% of your portfolio, I think it's a pretty good company. It still continues to do very well. Their revenues relatively, we'll know more tomorrow, Rhonda, but the revenues are pretty flat for this year. They've held their line this year despite everything that's going on. But that investor sentiment, that valuation part, that's actually doubled for Apple. So Apple is probably is double the expensiveness relative to just 9 months ago to itself. And so, but it's still a great company.
I think everybody's buying the MacBook too, because this is like the new normal of doing business, and the kids doing online schooling and stuff like that. So I know that they've had a banner year of MacBook sales too. So yeah, it's a great company. We've owned it for a long time. And to Ben's point, I think it bodes. It just depends on how big of a percentage of your portfolio it is. And there's nothing wrong with taking a profit, even if you have to pay taxes. Where do new, innovative startup companies fit into this investment picture?
Oh, that's a great question.
That's a good question.
Because and it's important to know that this is, the whole strategy that we talked about here, our whole process is the process that we have at Apriem, right? It's where we feel we have a competitive advantage in how we think we can make money for clients. But it's not the only way, right? There's many ways to invest in the market, and there's many ways to get the exposure and get growth for you. We tend to concentrate on everything Alan just mentioned about our process, about the economic moat and competitive advantages and cash flows. That generally leads, if you read between the lines, that generally leads to more mature companies. Okay, you cannot be positive. You generally are not positive cash flow if you're a young company, whether it be Tesla or whether it be WeWork, right? You're generally
Beyond Meat.
What?
Beyond Meat.
Or Beyond Meat, right? You're generally cash flow negative for quite a long time. And so we generally avoid them. We don't invest in companies that brand new companies that recently debuted as an IPO, or companies that are not cash flow positive, which are most of them. And so we do. It's not in our opportunity set. Not to say that you can't make money in those, but it's not in our opportunity set, because some of that requires a lot of subjective judgment, right?
We want to give it time.
Yeah, we want to give it time, but is that brand new technology going to work? Is it going to give that network effect, that Alan talked about? And that takes time. You're right. So we generally avoid those.
Great.
Can you explain the cap term again? What is market cap? When you say a mid-cap stock is $2 billion to $25 billion, $25 billion what? Can you explain exactly what that means?
Yeah, that's referring to the market capitalization. So market capitalization is basically just the number of shares of stock that a company has outstanding, and then you multiply it by the current share price of the stock. So it gives you an idea of the total overall aggregate market value of that company's equity is really what it is.
So let's take an example here, Alan. Right? Let's talk about Apple. Apple's a really popular today, one of the biggest companies in the world. Currently, it's trading at about $380 today. Mm-hmm. By the way, they report tomorrow. $380 is that a big market cap or a low market cap? Well,
there's no way to know.
There's no way to know, right?
For sure.
So Apple currently has about 4 million shares outstanding, right? That's how many shares they issued after splits and everything. You think that 4 million times today's price of 380, that's about $1.6 trillion. Yeah. So that's what you have to do the modal math, right? And in the past we talked about pie slices and everything, but you have to do the math with this. The number of shares outstanding times the current price and get the market. All this information is totally easily available on Yahoo Finance, on MarketWatch, on Morningstar. It's easy to find. Interesting at the top.
We have been through parts 1, 2, and 3. We talked about beginning with asset allocation, determining what that should be for your portfolio. Then we talked about laying that foundation for growth when we went through everything about bonds. And we talked about growth through the equity piece. That was everything we talked about today. However, once we get your portfolio put together, what then? What happens after that point? And so on August 12th, we're going to talk about bringing it all together. We're going to kind of talk about that long-term ongoing maintenance. However, we kind of want to change things up a little bit. We pay a lot of attention to feedback that you guys give us. One of the biggest pieces of feedback that we've gotten is that everyone really, really enjoys this Q&A portion of the webinars most out of everything that we do. And so what we want to do is we want to make maybe the first half of this part 4 presentation, kind of that presentation factual piece, but then we want to give a lot of time for Q&A. And in order to do that, we are going to submit a survey out to everyone to allow you an opportunity to submit questions ahead of time. And we are going to choose 10 questions from that survey that goes out. And whoever those 10 people are that we ask the question live, we are going to send you a gift. Now, I'm still trying to find out exactly what that gift is going to be, but I promise it'll be worth it and you'll love it. And so we encourage everybody to look for that email, submit your questions. I think it'll make for a really, really fun part 4. At the same time, we'd love to encourage you to register. So on to registering. So how do you register? So we'll have the registration available on the website. If you go there now, there's already a banner at the top of the page that would have allowed you to register for today's event. Up tomorrow, we will have the next registration available. You'll also receive a follow-up email that you can click. We'll have the 2 sessions again, 11 a.m. and 4 p.m. To make it really, really easy and simple for everyone. Now, if you have missed any of the previous webinars that we've done this year and you want to go back and you'd like to watch them or review something that you've seen previously, you can actually go to apriem.com/webinars, and you can find all of our previous webinars are available on there. One of the questions was, where can we see the articles that Ben and Alan were recently published in? Those are also available on our website. So if you go to our website, you go into the news feed that's there. You can look up any of the previous articles that anyone has been featured in, Rhonda, Alan, Ben. So there's it's a wealth of resources there that we're trying to make available to everybody, especially during kind of this period of time where there's a lot of questions and concerns about what's happening. So, and with that, I'm going to go ahead and turn it over to Rhonda to close us out.
Yeah, well, thank you. I want to first and foremost thank my team today. It's been a great day, lots of great questions, but I'm really proud of these guys. They put a lot of work into these webinars, and I just want to say thank you to them first and foremost. But thank you for attending. Our clients and friends and family who are on the line today, we really appreciate the participation. We hope you found it educational and interesting. We will be sending out, you're going to get an email right at the close of this today with a survey. We still love, I mean, as Josh mentioned, we love to improve in future sessions. So we really take the client feedback seriously. I think one of the recommendations was while they're waiting for the webinar to start, they didn't hear the music. You know, it was just silence. So we added the music. We're still trying to perfect all of these things. You know, this is the new normal, these webinars and the new way of doing business for the foreseeable future. But we really miss seeing your faces and being with you in person. So until we get back to the old normal, we'll have to do this technology thing, and we're still getting used to it. But again, with that, please fill out the survey. We love your feedback. But that concludes our event today. We hope you enjoyed it. Have a great night, and call with any questions. Schedule your portfolio review with your wealth manager, or call us with any questions. We'll see you soon. Bye-bye.
Thank you.